Good afternoon, Patrick Dwyer and Greg Poole again.
Hi there.
The Line Family Office at NewEdge Wealth. And today we want to just have a brief conversation about how we are compensated and how different people in the industry are compensated and how that creates conflict, because you as the client really need to understand how the recommendations get in front of you. So I worked at a broker-dealer for 26 years, and I certainly didn't feel like I was conflicted when I was there. But when you step out of it and move into a no conflict world, you realize that you were. When you're getting paid 3 times as much to offer someone private equity as you are stocks and bonds, that is going to catch your attention. It's going to catch your attention. So that's what we're here to talk about. So proprietary products, the easiest place to start is in a low conflict environment like the one that we work in. We don't have any. We don't have any proprietary products or additional compensation like carry or something that we created for packaging something together. Zero of that. The medium conflict model has, at an RIA, has some of these things in it. And so it isn't entirely clean. In other words, there are plenty of RIAs who charge significantly more for alternative investments. They build their own products where they add layers of fees and carry and so forth, which creates incentives for you to buy those because they're making substantially more if you're buying their private equity fund of funds where they get carry than just earning an advisory fee. And last is the highest conflict model, which is where someone it's typically at a bank, but it can be at an RIA as well, where you're getting paid on the brokerage side. You get paid on loans, you get paid on everything. And you don't have to choose the fiduciary way. You can buy something that has a higher fee. You can have conflicts with clients. It's more complicated, and there's greater compensation for the advisor.
Yeah, this is a very simple illustration of an actual fund that we talk about a lot, EXP. And this shows that, in fact, there are 3 different classes of investment funds that have very different fee structures. The fee structure that we put our clients in is the lowest one, and these are for very small investments. This is $10,000. In this case, there would be no subscription fee and no servicing fee. There's a class above that, which would have a subscription fee, in this case up to 1.5%, and a relatively small but existing servicing fee. And the class S has up to 3.5% subscription fee and 85 basis point servicing fee. That is a massive difference. And I would hazard that many of the clients and prospects that we talk to don't always know which class they're even in. So this is something that's important to know because there is no reason not to be in the lowest class fund.
Yeah, I mean, I find it shocking that this exists today in our industry. This is the same thing as like the mutual fund share classes that everybody went through forever. And it's a massive conflict. Why would someone pay multiples more for the exact same thing? The exact same thing. There's no difference here. There's none whatsoever. You're just paying your advisor today upfront instead of over time for advice. So that's our industry. Discounts and GP stakes. So what's important to understand is, as a fiduciary, we need to do what's in your best interest. And obviously, keeping fees down is in your best interest, right? Getting a lower fee on something is in your best interest because fees really matter and taxes really matter. So in a low conflict environment like Greg and I's team, any discounts or general partner stakes that are given to us by a private fund are passed directly to the client, ensuring alignment and transparency, right? So when we're offering you something, we're not making more money to sell that to you. In a medium conflict situation, the advisors can keep some of the discounts or the stakes for themselves, introducing mixed interest. And so often this is in RIAs, it's structured as a form of they create their own fund of funds, they charge a fee for that, or they charge carry in it. I mean, carry is incredibly lucrative if you're collecting it. So it's going to create some real biases. And that's a lot of the big RIAs all do this. And that is really no different than charging a commission or some other conflict there. And last, it's the highest conflict stake, which preferential GP stakes are not passed at all to the clients, and they're instead typically kept as compensation for the firm. So those are kind of like the 3 levels of lack of transparency.
And one of the justifications we hear is that when a discount or GP stake is negotiated on the client's behalf and not passed along, it's, well, the client's not any worse off than they would have been. But I think, again, that gets back to the fact that in a low conflict model, we're negotiating on behalf of the client's interests. And therefore, any benefits that we can negotiate will accrue to the client.
The way I sort of think about it is, and why I like this part of this side of the business is, we really work as closely for the client as humanly possible. You still work for somebody else, right? You can't walk away from that. But when someone's collecting these other things, they're not really working for you, they're working for their firm. And so you want to be more aligned with the client rather than less aligned with the client, because I think that's going to generate better outcomes for the client over time. This is the craziest thing ever. And we decided to pick like the simplest product in the world and show you how not opaque Wall Street is and how ridiculous Wall Street is. This is the cost of a direct index manager. Okay, direct index just replicates an index by buying the individual stocks and then does tax loss harvesting. Very simple product, great product. Everybody should have one because active management doesn't work over time. So these are all the big competitors out there. JP Morgan, if you have a $250,000 account, they'll charge you 0.23%. JP Morgan has $6 trillion in assets, a lot of negotiating power. Fidelity has a lot of negotiating power. We platform there. They charge 0.4%. BlackRock, 0.35%. Morgan Stanley, 0.35%. They own a direct index manager. They actually own the manager, which is fascinating. So what do we charge? And this is really fun. So the cost of a direct index manager at NewEdge Wealth is 0.15%. Whatever dollar amount you start, at $50,000, it's 0.15. So how can little tiny NewEdge, which only has $65 billion in assets, get a better price than JP Morgan? How is that possible?
I think the answer is because we're incentivized to negotiate on behalf of the client. Right. And so we do, whereas some of these other places, they don't. And, it happens that we also think Wise happens to be the best of the direct indexes, but it also is the lowest cost.
Yeah. And so that really matters. And fees and taxes are compounding. They compound in the future. But I think it's really important for you to really understand this.
This is a really important one to understand, and it's compensation across asset classes. So, in the low conflict model that we have, even if we're charging on an AUM basis, compensation is completely uniform across all asset classes. So when we come in, we never have any financial incentive to say you should be in a private equity fund or a venture fund over a 15 basis point direct index. In the medium conflict, advisors, might earn more for some strategies, usually being private deals, which can influence recommendations. And all that changes in the high conflict model is that, compensation level is even higher. So you're going to see much, much more dramatic compensation for the advisor in privates and alternatives. And this is really important because it's going to explain why people are constantly being suggested alternatives and higher fee, higher compensation products than they are very simple investment products. And we have no bias to pick one over the other.
It really, at the end of the day, what you're looking at is a difference between advice-driven organizations and sales-driven organizations. And, I worked for a sales-driven organization for a long time, and now I work for an advice-driven organization. And so I think this is really important distinction. I think technology is going to make this even more clear to clients as time goes on, because AI is going to bring transparency to things. And we are trying to educate our clients as to how we are incentivized. And we think that fees and taxes really matter, and we're going to minimize those for clients wherever we can. We want to be in the lowest cost vehicles in every asset class, the most efficient vehicles for our clients, because we work for them.
So thank you. This is, we think hopefully an illuminating, we find that our best clients and prospects are well-informed ones, because I think then they can understand the differences. We like to think it's not necessarily that a person is bad. It's if you take a person, you put them in a conflict-driven environment, they're going to behave differently. So we think these are really important things to be aware of and things that everyone should be asking their advisors.
Thank you so much for your time. Have a great day. Bye-bye.